Have you ever noticed something strange about the way most people work? They spend years working hard for money, while their money barely works for them at all. Think about it. You wake up early, you commute to work, you spend most of your day trading time and energy for a paycheck. But meanwhile, the money sitting in your bank account is growing painfully slowly. And after inflation, it may not even be growing at all. That realization changed the way I started thinking about money, because eventually I realized something important. Financial freedom usually doesn't come from working harder forever. It comes from building systems that allow your money to slowly work alongside you. Now, before you panic, this is not one of those videos telling you to become a day trader or gamble on random stocks. Honestly, most people do not need complicated investing strategies. What they need is a simple system. A system that is realistic, low stress, beginner-friendly, and sustainable for decades. So in this video, we're going to break down a very simple investing framework using one important milestone, your first $10,000. Because for many people, that's the moment investing finally starts feeling real. My name is Alex, and if you enjoy videos about investing, personal finance, and smarter money habits, subscribe for more videos like this. Now let's start with a problem most people completely underestimate: inflation. A lot of people think leaving money in savings is automatically safe, but safety is relative. If your savings account earns 1% interest, while the cost of living rises 3% or 4% every year, your purchasing power is quietly shrinking in the background, which means doing nothing still carries risk. That's important to understand, because many beginners think investing is risky while saving is completely safe. In reality, both choices involve trade-offs. One risks volatility, the other risks stagnation. And honestly, this is why learning basic investing matters. Not to get rich overnight, but simply to avoid falling behind over long periods of time. Now, another myth stops a lot of people before they even begin. They think investing requires huge amounts of money, but the truth is, investing is less about the starting amount and more about building behavior. Someone who consistently invests small amounts for 20 years will usually outperform someone who waits forever trying to feel perfectly ready, because consistency matters more than intensity, and this is where the psychological shift begins. The moment your investments start generating even small returns, something changes mentally. You stop viewing money only as something you spend. You start viewing it as a tool that can slowly produce more value over time. That mindset shift is incredibly powerful. So let's talk about a simple way someone could structure their first $10,000. Not financial advice, just a basic educational framework designed around stability, growth, and long-term thinking. The first category is protection. Before aggressively investing, having emergency savings matters a lot, because unexpected expenses happen to everyone. Car repairs, medical bills, job uncertainty, family emergencies. And without cash savings, people are often forced to sell investments at the worst possible time, which is why many financially disciplined people keep a portion of their money liquid and accessible. For example, someone with $10,000 might decide to keep around 20% in high-yield savings for emergencies and short-term stability. Not because it generates huge returns, but because emotional stability matters in investing. When you know you have cash available for emergencies, you're far less likely to panic during market volatility. The second category is long-term growth. This is where many investors focus most of their capital. Instead of chasing individual stocks or trying to predict the next big winner, many people simply invest in broad index funds. Why? Because index funds spread risk across hundreds of companies at once. Simple, diversified, long-term focus. Historically, broad market investing has outperformed most active traders over long periods, not because it's exciting, but because consistency often beats complexity. And honestly, that's something many beginners overlook. Successful investing is usually boring. It's patience, automation, discipline, long-term thinking, not constant excitement. Now here's another important concept beginners should understand: dollar cost averaging. Instead of investing all your money at once, many people invest gradually over time. For example, instead of investing $6,000 immediately, someone might invest $1,000 per month across several months. This reduces emotional pressure, and it helps avoid obsessing over perfect timing. Because the truth is, nobody consistently predicts market highs and lows. Not even professionals. The third category is flexibility. Some investors prefer keeping a small amount of cash available for opportunities, not to gamble, but to stay adaptable. Because during major market declines, strong assets sometimes become temporarily cheaper, and having cash available during those moments can provide flexibility instead of fear. Now, obviously, markets do not move upward smoothly forever. There will be downturns, bad headlines, fear, recessions, volatility. That's normal. But historically, markets have recovered from every major downturn over long periods of time, which is why experienced investors often focus more on decades than daily headlines, because short-term volatility is temporary. Long-term discipline is usually what builds wealth. And honestly, investing becomes much less stressful once you stop treating every market movement like an emergency. Now, there's something equally important that people rarely talk about enough. Your investment portfolio is not your only asset. Your skills matter too. Your career, your income potential, your knowledge, your network. Those things often have an even bigger impact on your long-term financial future because increasing your income gives you more capital to invest consistently, which accelerates compounding dramatically over time. This is why some people quietly build wealth even without massive salaries. They consistently improve their earning ability while steadily investing over long periods. That combination becomes extremely powerful. So let's simplify the key ideas from this video. First, build financial stability before taking large investment risks. Second, focus on long-term investing instead of chasing fast money. Third, use simple, diversified investments instead of overcomplicating everything. Fourth, automate investing whenever possible. And fifth, be patient, because wealth is usually built slowly, not instantly. And honestly, that may be the most important lesson of all. The people who build lasting wealth are usually not the loudest people online. They are simply the people who stayed consistent for years, while everyone else kept chasing shortcuts. So if you've been waiting to start investing because you feel unprepared or overwhelmed, start smaller than you think you need to. You do not need perfection. You need momentum, because over long periods of time, small, consistent actions often create extraordinary results. If you enjoyed this video, subscribe for more videos about personal finance, investing, and building long-term wealth. And I'm curious about something. What do you think is harder for most people? Starting to invest or staying patient long enough to let compounding work? Let me know in the comments.